Piece of me, piece of my, take some time. I'm just reading it slow, so for sure. It's just for me and my world. Be secure for the flow. Jesus, be my God.
Welcome to chapter 3, guys. We're going to be talking about a bunch of stuff. We're getting into the meat and potatoes of trading. This is going to be all of the stuff to basically start off your trading journey. So if you guys are watching, make sure to like, subscribe, leave a comment for any questions that you guys have. Again, you guys are watching a boot camp of a boot camp. So I have Nick and Victor again on the call. Teaching them, so you guys get to be a fly on the wall watching them learn as you guys learn. So we're going to be learning about what's actually happening when you're trading. Okay, so in this chapter you're going to be learning what happens when you press buy or sell, who you're trading with or against, why price moves up and down, and why price moves sideways. Okay, you guys can chime in and talk anytime you want. You guys have any questions, feel free to ask them. Remember, there are no dumb questions. Your questions can help them as they're watching this as well. So don't be afraid to ask any questions. As many questions as possible. Let's make this interesting. You guys can joke around, be yourselves. I'll edit out anything that will cancel me. Just remember that.
Everything I'm like, all
right, ready?
Yes, sir.
So what happens when you press buy or sell? When you're pressing buy or sell, it's going to be an agreement between a buyer and a seller. So you know how when you're trading, you know how it says like a contract, right? I told you guys in the beginning of what is a contract? And a contract is an agreement to the rights to buy or sell, right? So during trading, there's going to be what's called an auction, right? So the auction is going to be when you're entering, the buyer and seller is going to be on each side. So you're not trading with the market. You know what I mean? So the market is not some imaginary, like, Facebook marketplace where you buy and sell stocks. It's literally like a person is on the other side or a company is on the other side selling, and then there's a buyer on the other side or a seller on the side, and they're both agreeing on a price. And after you agree on a price, wherever the price goes on the chart, you're gonna be making the profits of the difference, if that makes sense. Okay. So no trade happens without an agreement. So nothing can happen if one side or the other side doesn't agree. Okay. When you're buying from somebody who is selling. When you're selling to somebody who is buying. You're not buying from an imaginary market. There is always going to be somebody on the other side. So who is on the other side? Retail traders. So majority of the time, we're the people that are called retail traders. And the retail traders are going to be the small account holders, the emotional traders, like, the video that you sent me the other day.
Yeah.
Those are retail traders.
Okay.
Which is also us. Retail traders encompass traders encompass everybody that is not a company or a hedge fund. So anybody that is trading just normally on their laptop or their computer is going to be a retail trader. They're focused on short term. So it's going to be day traders or short term swing traders. Well, technically, swing traders can also be retail. Yeah. So swing traders are also retail traders. I should have put that as a bullet point as well too. So it's going to be small account holders, emotional traders, impatient traders. All of them are going to be retail traders. Then you have institutions. So institutions would be the banks, the funds, like your Roth IRA and stuff like that, and firms, right? These are the people that have super deep pockets, that have millions and billions of dollars, and these are the people that move the market. So when you're seeing the price go up and down, that's because of them.
Yeah, they have money to risk.
Yes, they have money to risk. They have money to play. Our 1 to 2 contracts are not moving shit.
Right.
They're the ones that are putting in like thousands and thousands of contracts at a time to actually move the market. The institutions are also like, the companies that are like Apple, Tesla, and stuff like that are also in the market, that have their stocks as, open companies or public companies that are being traded on the stock market as well. So they're the main movers of price. And then you also have the hedgers. So the hedgers are the people that are working for other people, right? And they're investing their money. So those people were basically, they protecting risk, and they do not day trade. They only swing trade. Well, they could day trade. It depends on what the person that's hiring them to do is actually like hiring them to do. But majority of the time, they're looking for long-term gains, not short-term gains. Right? Let me know if you guys are confused, but this should be pretty self-explanatory.
Yeah.
And then how does price move up and down? Price only goes up when buyers are more aggressive. So when you see a big ass green candle, that means buyers are in control of the market. They're willing to pay whatever, and they're driving the price up. Price only goes down.
So whenever you see a jump, it's because there's been a lot of buys in that section?
Yes. So like, let's say if we go to trading view,
Yeah.
if you see a big ass red candle like this, hold on, let me go to, like, let's say this. Or for example, the news that we saw today, right?
Yeah.
This big ass red going down is a bunch of sellers aggressively selling.
Oh, shit.
So all these bars going down, 1, 2, 3, 4, those are all sellers like, oh shit, I want to get out of the market right now. Sellers are more aggressive, price goes down.
So the more people sell, the more the price is going to go down.
Yes.
Yes. Got it.
What the fuck did I just do? Okay, here we go.
Looking like me out there.
So aggressive means that they just want to be in the market. Okay, if buyers keep paying premiums, meaning they don't care what the price is, they're willing to pay whatever, they just want to be in the market, the price is going to go up. You know what I mean? Like, let's say, for example, you're buying a bed. If somebody's willing to pay like $1,000 for the bed, the price will be $1,000. But then the person will be like, oh, let me see if I can sell it for $1,500. You know what I mean? The price is just going to keep going up. When sellers are in control, it means that basically it's a race to the bottom, right? Somebody is undercutting another person, and another person is undercutting another person, another person is undercutting, and the price just keeps dropping and dropping and dropping, right? Until it reaches a point where price is at a complete super discount, and there's only one thing left but to go up. You know what I mean? And that's when buyers take over and start. Yeah, it's a complete cycle. It goes from buyers to sellers, always. Buyers to sellers, buyers to sellers. Okay, what happens when price moves sideways? So buyers and sellers are balanced. That means there's no discount, there's no premium. It's exactly the same. And it just moves up and down. So an example of sideways price action would be right here. So like you see how there's a fat green candle, a bunch of greens, and then it's just in the middle, not really doing nothing. And then you see a fat green candle again. So this little area right here is called consolidation. That would be sideways price movement. Or another example would be this right here. This is where the market doesn't really know what it's going to do. It doesn't know if it wants to go up. It doesn't know if it wants to go down. It's just moving sideways. So whenever
That's why it's more
dangerous.
That's why it's more dangerous, because you never know if you're going to lose your butt or you're going to gain a bunch of money.
Yeah, because you could be in this trade and then randomly the buyers are like, oh, we know what we want to do, and it'll just shoot up. Or the sellers are going to be like, oh, we know we want to sell now. It shoots down. You know what I mean? So trading in this type of market right here, you always want to avoid. You never want to step into the market or place any orders if price is moving sideways. Because if they don't know what to do, 100% you don't know what to do. You know what I mean?
Right. And that's in a time span of how much, Nate?
So each bar, I'm on the 1 hour time frame right now. So each bar on this chart represents 1 hour.
Yeah.
So this is what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24 hours. So a whole day of just, I don't know what to do.
Oh man, that's a hectic day right there.
Yeah. And guaranteed, 100% of people, not 100%, but I'm going to say a majority of retail traders that were trading in this lost a fuckload of money.
Right.
Damn.
Because
when everyone didn't know what to do, it was time to sell.
Yes. So a lot of the times, like, people lose money when they just want to be in a trade. You know what I mean? Like, they're not paying attention to what's going on. Majority of the time, you only want to get in a trade when price is moving up or down. If it's moving sideways, you want to stay out. But
Yeah, I was gonna tell you that. Sorry.
yeah,
So when the price is like stagnant like that, like you said, the best thing to do is like
don't
stay
even
still,
trade.
right?
Yeah, you could just watch the chart and see what happens, but I would never get into a trade at those times.
Okay.
A lot of people that are starting make that mistake and get into the trade because of FOMO. You know what I mean? Like the fear of missing
Yeah.
out. Like, oh, I need to be in something.
Could they see movement?
Yeah,
Yeah, I know
they're
what you
seeing
mean.
movement, but they're not looking at the bigger picture.
Okay.
So I'm gonna break down what I'm talking about exactly there in a little bit.
Mhm.
So how
Gotcha.
am I selling something I don't own, right? So you know how in options and in regular stocks you're buying the stocks and then you can sell them and then you make a profit if it goes up, you know what I mean? But you can't make a profit if it goes down. You're just losing money. But in terms of futures trading, you're not trading, you're not owning. Like I said in the last video, you're coming to an agreement. So I changed the terminology to agreement. So buying a contract equals agreeing to buy at a certain price. Selling the contract equals agreeing to sell at a certain price. So buy and sell, agreement closed. Sell, buy, agreement closed. Do you get what I mean?
Yeah.
So you're not technically owning it. You're just debating with the other side. Like, hey, are we cool with this? And if we're both cool, all right, we're good. Is the market random and am I gambling? Short answer is no. You are not gambling. Why? It only looks random on short-term things. So, let's say you're looking at the 5 minute, right? On the 5 minute, it looks like random ass stuff. You know what I mean?
Yeah.
Fucking heartbeat.
Yeah, it looks like a heart monitor. It doesn't look like it's doing anything. Like if you don't know how to read the chart, it's just like, oh, whoever's trading is just gambling. Like, you know what I mean? How can you read the chart? Stuff like that. That's the main misconception about trading is like we're gambling. But in reality, if you're looking at the longer time frames, right? It's more of like you see a better picture. You know what I mean?
Yeah.
So like, so the time frames are just, think of it like a microscope, right? So this would be the 1 hour time frame. Each bar represents 1 hour. But when you go to the 5 minute time frame, each bar represents 5 minutes. So you think of it as like looking into the pores of the whole chart. And then if you go even higher, 4 hour or like the monthly charts, you're going to start seeing patterns, which is why we say trading is not gambling, because if you're looking at patterns, majority of the time you're going to see things that are repeating. You know what I mean? When it comes to people and money, habits repeat all the time. You know what I mean?
Yes, they do.
So nothing is random in trading. People that don't know what they're doing, like the video you showed me where they're like screaming at the TV,
Yeah.
those people don't know what they're doing and they're gambling. So long term is repeating behavior. Understand that when it comes to humans and money, patterns are always repeating. So you always know when people get scared, they're going to sell. When people get greedy, they're going to buy. Right?
Yeah.
When you're trading, you are never predicting. You're only reacting to behavior. So whatever you see on the chart, you're reacting to people's behavior. And then that's this one. So that's chapter 3 of the course. Let me know if you guys have any questions. This was a little bit self-explanatory on how, like, basically how the market moves and who you're trading with. If you have any questions, let's take a little moment to answer.
Yeah. I mean, you explained everything great, so I appreciate it.
Okay. Vic, you good?
Yeah. Thank you, Nate. Yeah. Thank
All
you.
right, perfect. Okay, there you guys go. That was chapter 3. The next chapter, we're going to be going into actually how to read the chart and what is on the chart. Okay, so thank you guys for watching. We're going to go to the next chapter in a little bit.